Pretty laser focused. We're going to be looking back at the financial year that just ended.
Bit of a retrospective.
Exactly. We're analyzing the most common mistakes so that you can proactively build some, financial resilience for 2026.
Yeah.
We've pulled together a bunch of recent sources articles, some research, and maybe most importantly, some fresh survey data to give you a really detailed, actionable blueprint.
And it's really the best kind of planning, isn't it? I mean, we all wait until January 1st to set these big new goals, but the real power comes from understanding where things went wrong last year.
Mm.
We're not here to, shame anyone. We're here to map out the terrain of financial failure so we
Right.
can all navigate it a little better this year.
Absolutely. And the backbone of our whole analysis today is a recent Credit Karma survey. They asked over 1,000 Americans to get real about their biggest money challenges from the past year.
And people were pretty honest, it sounds like.
Oh, they were incredibly transparent about their regrets with spending, with saving, and that transparency is what lets us distill everything down to the three main weaknesses we really need to fortify in 2026.
And if you just step back for a second and look at these regrets, they're rarely, these massive unforeseen economic disasters.
Right, it's not like a market crash.
No, not at all. They are almost always decisions that felt, well, rational or maybe necessary in the moment. But when you add them all up, they create this significant financial drag. It all stems from emotional reactions or just a lack of basic planning.
So if we look at the scorecard of regret, we can see where those emotional decisions led.
Okay.
The single largest financial regret cited by Americans, and this is kind of the umbrella for everything else, was simply not saving enough money. That was the final tally for 38% of people.
38%. That is a huge number.
Hmm.
And it really represents a massive lost opportunity. So to really help you, the listener, we have to look past that general regret, right? We have to find the specific actions that caused that savings deficit.
Yeah, what was underneath it?
Exactly. And the sources we looked at, they really zero in on three behaviors that sabotage people over and over again.
Okay, let's unpack this. What were the specific culprits feeding into that 38% failure to save?
What were people actually doing?
Well, the next major specific regret, claimed by 28% of Americans, was making impulse purchases.
The big one.
Then you've got a tie for third place at 14% each, not saving for retirement and overspending because of pressure from a partner or friends.
So if you just add up the people who mentioned impulse buying and social pressure, you immediately account for a huge chunk of that general savings problem.
Right, adds up fast.
These are the behavioral traps. If we can fix those two things, that 38% group gets a lot smaller.
Let's start with that impulse problem then. It's the biggest specific regret. And our sources really get into the behavioral mechanics of it. They point out that impulse buying isn't usually about needing a product. It's about needing a feeling. People are shopping because they're bored or stressed or anxious, and they're looking for that temporary emotional fix, that little dopamine hit.
Exactly. It's the emotional brain. The fast reacting part, what psychologists call system one thinking, just taking over. The rational, slow-moving brain is tired or overwhelmed. So that immediate reward system gets triggered, and we end up trading long-term security for a little bit of short-term comfort. And this is why advice like just budget better so often fails. It doesn't actually address the emotional trigger.
Right. So the key isn't just to have more willpower. It's to build a defense system. And the sources propose this fantastic concept, adding friction to the shopping process.
Friction is brilliant. It's so smart because it forces that system two, that rational analyzing part of your brain, to catch up. It creates that necessary pause between the urge and the action.
And we've got three clear, really practical suggestions for creating this friction based on the research. Number one, do not save your payment information online.
Well, that's a good one.
Yeah. Make yourself manually type in that 16-digit card number, the expiration date, the security code, every single time.
That moment of inconvenience, right? That physical task.
Okay.
It's often enough to break the spell.
It is.
You realize you've been scrolling for 15 minutes, you have to get up, find your wallet, and suddenly the urge to buy that thing you didn't even know existed 5 minutes ago just kind of disappears. It interrupts the cycle.
The second suggestion, limit your shopping to in-person purchases only. Now, this is a more dramatic step, but it's powerful.
Yeah, that's a big one.
It eliminates the 2 a.m. stress-fueled shopping spree completely. You have to physically leave the house, invest time and energy, which, again, just adds that friction.
Right.
And finally, number three, this connects directly back to that dopamine chase we talked about. Build a go-to list of free mood boosters.
So alternatives.
Alternatives. You need them ready to go before you'd even pick up your phone or your credit card.
Because if the goal is just to feel better, you need to have better, cheaper, and frankly, healthier ways to get that feeling. Our sources recommend creating a list that's categorized by need. So if you're bored, what's a free creative thing you can do? If you're stressed, what's a free physical activity? If you're lonely, who can you call?
Right.
By defining those alternatives beforehand, you stop relying on shopping as the default path to feeling good.
It takes the power away from the marketplace and gives it right back to you.
So we've talked about internal friction, building barriers against our own boredom, but what about barriers against external pressure? That brings us to the second big area of regret, the high cost of social connection.
And this is where things get really tricky because the costs aren't just monetary, they're emotional. You don't want to miss out on the group cabin trip or that expensive wedding or even, a weekly team dinner that costs $70. Maintaining relationships, it just inevitably strains a budget. And that 14% regret rate shows how often people just cave to the pressure. Here's where it gets really interesting. How do you say no without sacrificing your social life? Or worse, damaging the relationship?
Well, the sources suggest that the most successful strategy, and they cite behavioral finance experts like Reddy Hefner, involves honesty, but coupled with a clear alternative. The key is to never just say, no, I can't afford that. It's always no but.
And the communication strategy has to be different depending on the relationship, right?
Absolutely.
So if it's a casual acquaintance, a coworker asking you out for an expensive Friday happy hour, you can just be, succinct, businesslike.
Right.
A simple, hey, I can't make the high-end cocktail bar, but I'd love to join you for a quick coffee on Tuesday instead. That's usually enough.
Yeah, you've set the boundary. You've offered a firm but friendly alternative, and you've moved the conversation forward without having to overshare your whole personal budget.
But when we're talking about more substantial relationships, a lifelong friend, a sibling, especially a romantic partner, the need for full, brave transparency is just. It's non-negotiable.
It is.
You can't just offer a quick alternative. You have to have that deeper conversation about your shared goals.
The sources call this an act of bravery. And it really is. It feels vulnerable in the moment to say, hey, I can't afford this because I'm trying to hit this savings goal. But that vulnerability, it builds so much trust. If your closest circle understands your goals, they become collaborators instead of sources of pressure. They stop suggesting things that break your budget, or they actively help you find cheaper alternatives. It removes that long-term friction from the relationship.
You're reframing the whole conversation. It's not about scarcity, I don't have money. It's about a shared purpose. I value our long-term security, and here's how we can still spend time together while we work towards that.
That is a massive shift, a huge shift in perspective that saves more than just money.
Okay, now let's transition to our final behavioral target, not saving for retirement. It tied with social pressure at 14%. The urgency here is pretty clear because of, the power of compounding interest.
Right.
But if you're sitting there regretting not saving last year, the central message from our sources is that it is absolutely 100% not too late to start now.
And when it comes to retirement, the most powerful thing anyone with a steady job can do is focus on maximizing employer benefits. If you have access to a 401k, you absolutely must check the details of the employer match.
Why is this the absolute first step?
Because the match is the single easiest way to capture a guaranteed tax advantage return on your investment. It's essentially free money that instantly increases your wealth. If you are not contributing enough to get the full match, you are voluntarily declining a guaranteed raise. It's that simple.
Let's get into the mechanics of that because this needs to be crystal clear for you. Our sources detail two really common matching structures. Can you walk us through them with some numbers?
Certainly. So the first is a dollar-for-dollar match up to a certain percentage of your salary, let's say 3%. If you make $60,000 a year and you contribute 3%, which is $1,800, the company instantly contributes another $1,800. You've doubled your money immediately.
Right there. Instant 100% return.
The second common structure is the 50 cents on the dollar match. So this means for every dollar you put in, they put in 50 cents, usually up to, say, 6% of your salary. So if you contribute $3,600, which is 6% of $60,000, the employer gives you $1,800.
Got it.
Your goal in either one of those scenarios is just to contribute enough to capture the full percentage of their match. It is the single highest guaranteed return you will ever get. period.
But I do want to push back on that a little because for someone who's living paycheck to paycheck, even 3% or 6% can feel impossible.
That's a crucial question.
What do the sources say about handling that reality when you feel like you just can't contribute?
The sources emphasize starting incredibly small if you have to,
Yeah.
even 1%. The point is to create the habit and the structure. Then you use this key psychological tactic called pay raise optimization, which ties directly into your plan for 2026.
Okay, let's talk about that strategy, the one around pay raises, because that seems to be where the growth can happen, painlessly.
Exactly.
So if you know you're getting a pay increase in the new year, let's say it's a 3% bump, our sources strongly recommend immediately allocating a portion of that raise straight to your 401k before you ever see it in your checking account.
This is the perfect defense against what we call lifestyle creep. That's when your spending just automatically expands to meet your new higher income.
Right. More money, more spending.
By allocating a portion of that raise to savings before it even hits your budget, you never feel the sacrifice.
So the positive step is this. If you get a 3% raise, you tell HR to increase your 401k contributions by 1% right away. And then you enjoy the other 2% increase in your immediate cash flow. You've prioritized your future, you get a small immediate bump, and you barely notice the change in your contributions. It's this automated step forward every single year.
It leverages inertia in your favor. And for those of you listening who don't have a workplace retirement plan, maybe you're self-employed or work for a smaller company, you don't just give up. You pivot those extra funds to an individual retirement account, an IRA.
Right.
The mechanism's a bit different, but the goal is exactly the same.
Right.
Automate that small, consistent saving.
So this deep dive has really synthesized the biggest financial regrets from last year into a set of powerful defensive maneuvers for 2026. Just to summarize the core strategies we've built from these sources. 1, you're consciously adding friction to your shopping routine to beat emotional impulse buying.
Right.
2, you're creating and using a personalized list of free mood boosters. 3, you're using brave transparency when you handle social spending, especially with your close partners. And 4, you are immediately prioritizing and capturing that full 401k employer match because it is structurally an instant wealth generator.
So what does this all mean for you as the learner? It means that financial success, it isn't defined by one single heroic act of saving. It's built on a series of small, positive, automated steps that you take consistently.
Yeah.
The research shows that strategies like immediately allocating 1% of a raise year after year, they compound into massive long-term wealth, all without requiring you to go through some painful financial overhaul.
Yeah.
Consistency beats intensity. Every time.
That distinction between intensity and consistency is so key. And as you step into this new year with this proactive plan, I want to leave you with one final thought drawn directly from our discussion about impulse buying and that dopamine chase.
Okay.
Challenge yourself this week to create your personal list. Challenge yourself to list 3 non-monetary activities, specifically physical, social, or creative, that provide a superior, longer-lasting mood boost than any purchase ever could. Go find your better dopamine.